If you are not waiting for the 5 signals professional traders use before entering a trade, you are likely part of the 95% of traders who become liquidity for the real move. The market does not remove traders randomly. It removes those who enter before the move is ready. In this video, you will see the 5 signals professionals wait for before committing capital. Because the difference between traders who survive the market and those who constantly get stopped out often comes down to one decision: when they choose to enter. Most traders believe their losses come from bad analysis, but in many cases, the direction was actually correct. The market eventually moved exactly where they expected, yet the trade still failed, not because the idea was wrong, because the entry was too early. The market had not confirmed the move yet. Professional traders understand something simple. The market does not reward prediction. It rewards timing after confirmation. And this single difference determines who survives the market and who becomes liquidity for the move. Many traders try to enter at the exact turning point, the perfect bottom, the perfect top. It feels analytical, it feels impressive, but in reality, this is one of the most dangerous habits in trading. Before strong moves begin, price often behaves in 3 stages. First, the market moves sideways while traders disagree. Second, price briefly breaks a high or low to trigger stop losses. Third, the real directional expansion begins. Traders who enter during the first phase are simply guessing. Professionals wait until the market shows its hand. They wait until the market proves the move is real. One of the most important principles taught by legendary trader Jesse Livermore was simple. Jesse Livermore understood something most traders ignore. He did not buy weakness. He bought strength after the market proved itself, because when price confirms direction, large capital is already moving. And when large capital moves, trends begin. The goal is not to capture the very first tick. The goal is to participate in the real move. When traders enter too early, they usually place tight stop losses. But during the early stage of a move, the market is still clearing liquidity. Stops are triggered, weak positions are removed. Then the real move begins. This is why many traders experience something frustrating. They get stopped out, and seconds later the market moves exactly where they expected. The analysis was correct, the timing was not. Professional traders rarely enter randomly. They wait for a sequence that repeats across markets. When these 5 events appear together, the probability of continuation increases dramatically. First, consolidation. Price moves sideways while liquidity builds. Second, liquidity sweep. Stops above highs or below lows are triggered. Weak traders are removed. Third, break of structure. The market shows a clear directional shift. Fourth, retracement. Price returns to an area of imbalance or unfilled orders. Fifth, confirmation. Momentum continues in the same direction. Only after these conditions appear does the entry become statistically favorable. At that point, the trader is not predicting. They are reacting to evidence. There is a simple test for trading discipline. When the market begins moving, can you watch the move without entering? Most traders cannot. They feel the pressure to participate immediately. Professionals think differently. They understand something uncomfortable. Not every move belongs to them. Professionals often follow a simple rule. If the move begins without confirmation, they let it go, because chasing weak entries creates bad habits that destroy long-term consistency. But the moves that do belong to them arrive with confirmation, and those trades rarely require chasing. Most traders are not losing because they lack knowledge. They are losing because they enter too soon. They predict the move. The market removes them. Then the real trend begins. Patience in trading rarely feels exciting. It often feels like hesitation. But patience is not hesitation. It is positioning. Waiting for confirmation does not mean arriving late. It means arriving after the market reveals its intention. And in professional trading, that difference changes everything. The market does not reward the trader who arrives first. It rewards the trader who arrives when the move is real. If this changed how you see your entries, continue the training.